Welcome back to Bloomberg Markets. I'm John Ehrlichman. We talked about affordability, a challenge for Canadians right now when they are doing a lot of traveling as well. And one of the big questions going forward is, what is affordable if you're looking to do some traveling? Well, a fast-growing Canadian startup is trying to help tackle that issue. Hopper is an online travel agency. It uses technology to predict future travel prices. The business has attracted some high-profile investors, not to mention a multi-billion-dollar valuation. Fred Lalonde is the co-founder and CEO, and he joins us to talk a little bit more about the business. Thanks for your time.
Thanks for having me.
I know you've been building what you've described as a travel super app. Maybe you can fill in the details on how it works.
Yeah, absolutely. Obviously, Hopper started by predicting airfare, which we were alluding to. So we help people save money by telling them when is the actual best time to buy that flight that you're looking at. That was in 2014. Now we're expanded. We have over 100 million customers. And what we do around the world is make sure that we're the cheapest place to book travel. And one of the things that we've been doing is looking at what's being done in Asia. And the super apps do all sorts of things out there, which we've been incorporating, including giving you future booking credit, letting you earn money by sharing the app. All this kind of comes to fruition just to make it cheaper to plan and book travel around the world. And obviously, being an app, our customers are young. They don't have as much income as their parents, for example. And as times get harder, we tend to attract people looking for a deal.
And are there any anecdotes you can share on once someone is curious about future travel, how they end up using it for some of the other things the app has evolved to become?
A lot of what we do is reward our customers. So for example, if you're planning a trip and maybe that ticket that you're looking to buy for Europe is too expensive, you can just share the app and earn credit. And sometimes this can amount to hundreds of dollars. We have people that have large social media followings that have actually traveled for free. So that's part of our partner program. You can also accrue credit by booking. So if you come in, you use the planning capabilities of the app and buy your ticket at the right time, the air ticket, you'll get some credit towards the hotel. So all this comes together to help our customers save. There's also games in the app, and we run regular sales, and some of these sales have crazy deals from our partners. Again, this is all inspired by what you will see if you look at how Chinese or Asian apps work.
Fred, there's been a lot of excitement this year around what artificial intelligence can mean in different industries. We've heard a lot about the influence it can have within the online travel world as well. Does AI play a role in what you're doing, Hopper, as well?
So obviously the new wave of AI has a lot to do with generative AI, large learning models, large language models that give the impression that you're talking to a human being. But AI has been around for a while. What we've done with it for over a decade now is use it to dynamically price some of our more bespoke and sophisticated products. So for example, on Hopper, you can freeze the price of a hotel or a flight before you buy it. So we'll hold the price for you. If the price goes down, you pay the lowest. If it goes up, we pay the difference. A lot of what we do for these products is use AI to predict price changes to figure out how much we should be selling this product for, how much we should be charging to hold the price. We do this for our disruption products, for example. You've heard a lot of load on the airline system, especially in the US this year. We have our disruption protection that lets you get rebooked for free on any airline within an hour. We also use AI to price all of that. Those products are easy to make, but they're hard to consistently price in a way where you can make money. And we've been doing that for a while now.
And I mentioned you've got some high-profile investors as well. For those who are curious about how the business ultimately works, financially speaking, what is the evolution of that as well, and how could that continue to evolve?
So we started as a consumer app, and we were selling travel. And when you do that, hotels and airlines will give you commissions. But when we really broke out, which would have been 2019, is when we started with these fintech products. So things like making non-refundable fares refundable for a small fee, freezing prices, disruption protection. We even have a super popular product that lets you leave a hotel room even after check-in if you don't like it for any reason. So all of these suites of products that ultimately allow customers to buy out the anxiety that comes with planning travel now represent over 50% of our revenue. And it's because of this revenue that we've been able to lower prices in our app. We also have a very large enterprise business, B2B, where we power all sorts of third parties, both with the travel and the financial products. Capital One, Uber, for example, are some of our customers on the B2B side.
Okay, so we've talked a lot about planning and predictions. We get a lot of that on our channel, and we've had some guests who have predicted that you one day could be a public company as well. What's your long-term plan for growth from here?
Eventually we're going to list. We're getting at a scale now where it makes sense to be contemplating the markets, but as we're getting ready for that, that's not short term. So first of all, we want to give the market some time to recover and digest from the correction, but we're scaling so quickly, especially in places like Asia and Latin America, that we want to make sure that we are focused on growing the business, growing our customer base before we think of a public listing. But eventually it's probably in the cards. Any
final advice to anyone who has done some frustrating travel this summer? It's obviously getting a lot of headlines.
It's going to get better. Capacity's coming back. The advice that I give everybody, apart from using our app, which is pretty obvious, is that, just book early. The prices tend to go up. There's still supply that's crunched. The easiest thing you can do is plan ahead. And what I would also advise is that avoid the peak travel dates, at least for another year. We suspect that next year rates will normalize and capacity will look better, but we just have to push through what's coming up for the rest of the summer.
Okay, Fred, thanks for your time today. Appreciate it.
Thank you.
Fred Lalonde, co-founder and CEO of Hopper, joining us.
Canadian fashion designer Joe Mimran has been a leading contributor to the fashion and design industry in this country for many years. He brought us retailers like Club Monaco and Joe Fresh. Now he's adding Vancouver-based clothing retailer Kit and Ace to his portfolio. Kit and Ace was founded in 2014 by the former lead designer of Lululemon. For more on his plans for the brand, Joe Mimran joins us now. Joe, thanks so much for making time for us today.
Yeah, pleasure to be with you.
So this really jumped out to me because, we've seen other retailers pulling back right now in the space. I'm thinking of Nordstrom even leaving the country entirely. What makes now a good time to scoop up Kit and Ace from your perspective?
I think the brand has been underrepresented in Canada. And we just thought that it had such a great following. It has a very loyal fan base of millennials, particularly on the men's side of the business. Their clothes are perfectly geared to the hybrid worker and the active lifestyle that I think everyone has been embracing, particularly during COVID and now coming out of COVID. And so we liked it a lot. We think it's been under potentialized, and with a little bit of elbow grease, I think we can get this brand growing again.
Why do you think that is? Why do you think it has been sort of underrepresented?
Well, I think that with the amount of work that was done initially with the brand, it was originally known as for its technical cashmere. It grew very quickly, and then it pulled back, and then it changed hands. And I just think it's had it's sort of ups and downs. And then I think COVID was kind of something that really impacted the brand as well over the last couple of years. So we just thought it was a great time. When people are pulling in, we think it's an opportune time to be buying. So this sort of the doldrums in retail will not last forever. I think we're going to go through another 12 months of a difficult downtrend, and then we'll be very well poised when the market turns around.
So what are your plans for it then, Joe? I mean, like you mentioned, it did expand and then pull back. I believe it just has 4 locations now: Vancouver, Calgary, one in Oakville, Ontario, and Toronto as well. Do you see brick and mortar as being a major component of Kit and Ace going forward?
Yeah, absolutely. The stores are performing extremely well. And so we are going to be opening 2 more this fall. And then we will be embarking on a growth plan, but we'll be very, very cautious. And that goes without saying.
You'll be cautious? What do you mean?
Well, cautious in the sense that our plans are not to grow, I would say, irresponsibly. I think we will grow with measured steps. But as long as we're getting the results from, and the performance is showing that this brand can expand and certainly can expand beyond Canada. But we'll start with the 2 stores this fall. That'll bring us to 6. We have a very, very strong e-commerce business, and so that is something that we will be leveraging as well. And there's great brand recognition. I mean, this is a brand that is very well known, and we're going to be putting our design capabilities behind it, our sourcing capabilities behind it. And so we're just very excited to be taking this on. And I've always been a believer in Canadian brands, and I think Canadian brands can succeed. And we have great Canadian talent, design talent in this country. Yeah, very excited. We acquired Tilly's Tilly Endurables, the venerable hat company, a couple years ago. We've been growing that. We're in the UK. We've expanded to Australia. We're in the US. We've expanded the product lines. So, we believe in Canadian ingenuity and Canadian products.
I mentioned your other 2 retail ventures of your past, Joe, being Club Monaco and Joe Fresh, and they just have such clear, target, buyers. I think of the objectives as being quite clear just from the outside, anyway, when it comes to those 2 retailers. When you think about Kit and Ace, you mentioned millennials. Is that going to be your sort of target customer going forward?
Absolutely. It's perfectly geared, as I said, to the hybrid worker, and they have a very active lifestyle. So they ride their bike to work. They then may play a round of golf, or they may go out afterwards, after work. But they're always moving. There's always this notion of comfort, and also the product. If you look at it, it's elevated essentials, and there's a real focus on fabrication, technical fabrics that work all day long, work hard, they breathe, they move. And so that's really that's really going to be the focus of the brand.
And Joe, just really quickly, you teamed up with some others in order to do this through a new holding company. And I just wonder, the fact that you're doing this through a holding company, do you have plans to pick up some other retailers along the way?
We absolutely do. Our goal is to continue to build out and to look for opportunities. And we just think now is a great time to be doing that.
Joe, thanks so much for joining us today to tell us about it. We really appreciate it.
Thanks so much.
That was Joe Mimran, a Canadian fashion designer and entrepreneur.
Okay, with interest rates and inflation in focus this morning, obviously companies themselves have to navigate what consumers are thinking about. Pizza has decided to fight back with what they're calling growflation, taking a small pizza and making it 44% bigger for the same small pizza price. And so we dragged Andy Bell in early here to do a little bit more analysis on this story with some product I see there.
That's
Mr.
right.
Bell.
Yeah. We've been carrying out rigorous research, and I'm hoping to have this for breakfast. It'll bring me back to my bachelor days. So anyway, I'm not sure we can get a shot here. Here is was supplied by Pizza. On one side, I'm going to point to it, is the small pizza. And here is the larger, the growflation pizza. So we've been conducting measurements, and the smaller pizza is roughly 24 centimeters. I'm going to go metric here. The bigger one is 30 centimeters. Now, we're talking about diameter. So you might say, well, that's an increase of only about 25%. Where's the 44%? But of course, the crucial metric is the area of the pizza. So pi r squared, let's get that pun out of the way. But in any case, we're calculating that the area of the smaller pizza is 432 square centimeters. The larger one we're putting at 675 square centimeters. So that is an increase of roughly 56%. So for sure, this bigger pizza is truly more than 44% larger. So that's good news. They always say quantity has a quality all of its own. My wife accuses me of sometimes eating until I'm in a stupor. Maybe other wives or partners can testify to that kind of thing. But in any case, yep, it checks out. This pizza is significantly bigger.
Andy, that is the most exceptional analysis of pizza I've ever seen in my life. We appreciate it. Andy Bell joining us. Let's keep the conversation going. Paul Goddard is the CEO of Pizza Pizza, and he joins us here on set. What do you think of that analysis?
That was bang on. Thanks, Andy.
So you guys have been having a little bit of fun with these issues that are important to Canadians. You previously had this campaign where people could lock in a price for a year to deal with inflation, and now you're saying we're going to change the narrative here to grow inflation. How'd this come about?
We did. Yeah, you're right. About a year ago, we came up with a fixed rate pizza, $16.99, 4 toppings, and we've held that even longer than we thought we would originally, and that's going until the end of this year. And that's worked really well. It's our second most popular mixing special right now. But around the time, I think just a little bit after last summer, we also started to notice people talking about inflation even more. And I think there's an Ipsos Reid poll done in the spring saying 82% of people were concerned about shrinkflation. And roughly that same number, I think 82% had seen their grocery bills go up in the last 6 months. So still a lot of ongoing concern about inflation. So we thought, well, rather than having, participating in this sort of market where you see a lot of people, not to pick on anyone, but, cereal box companies is one that people used to think about, where they made the box smaller.
Yeah.
But they charge the same price.
That's right.
This is a shrinkflation.
And everybody just shares that stuff on social media
sort
too.
Of giving a smaller amount of volume for the same price. We thought, well, let's flip that on its head. Let's have a growflation. Let's have a pizza that you're getting a medium pizza for the price of a small. So everyone gets more pizza. Everyone's happy.
Does this become part of the story we have to watch with brands like yours? We've seen a resilient consumer, right? But we keep talking about this cooling effect. And I guess if you're competing with others for every available dollar they have to spend, you have to get a little bit more innovative with your campaigns?
Yeah, I think you really do. You've got to be creative. And I think, if you're going to be a leading brand, you try to get that credibility and keep that and earn that trust and maintain it. And I think we've tried to do that. We're always trying to get that convenience factor, that accessibility, and the quality, all at a decent value. Yeah. And have a bit of fun with it as well. I mean, it's a serious topic, obviously. Yeah. It's hurt a lot of people, inflation. Now we've got interest rates. It looks like they're going to go up again. This half a point or whatever, a quarter point today. Yeah. People are still feeling the sting. So we are saying, well, look, it's still a good time for pizza. It's still very affordable. You can do it. We can give you a little more and a little more happiness for you. You should lobby for the marketing spot where Tiff Macklem, the Bank of Canada governor, sits there and talks to reporters. You have some pizza placement there. We can do that. But what about your own prices? I mean, if you're going to grow the size of the pie, I think a lot of people have said, well, for the companies themselves, their input costs have been higher. How are you navigating? Yeah, that's very true, and it is tricky. I mean, and one part of this would be that behind the scenes, we want to make sure we're not hurting our operators because they also, like you say, they had increased food costs, rent, labor's a problem. Everything's challenging these days. That hurts us. It hurts our franchisee base across the country. So we're assisting with that a little bit. We have some marketing budget. We're going to make sure that we don't hurt our operators by offering this. So the customer benefits, they get that medium pizza for the price of a small, but we're not going to economically hurt our operators. They're very important to us. Okay, so you're growing the pizza size, right, but you've also been growing the business. We talked to you about the Mexican expansion already. Even with uncertainty in the air, do you feel confident enough to keep growing the actual enterprise? Absolutely. I mean, we think it's just an absolute imperative that we do grow. And, the caveat is we want profitable growth. We're not just going to grow for the sake of growing. We could grow much faster than we are. And yet we're growing very rapidly, but we're going to do it in a profitable, measured way. And with Mexico, that's part of the same story. We're going slowly there to some extent, but we're also going as fast as we can go, making sure we get great locations. We have a great partner down there. The market loves the locations so far. We've got 3 of them. And in Canada, we're growing at a roughly 3 dozen a year pace as well, even net of closures. So we're pretty excited about that pace. Okay, Paul, thanks very much. Appreciate it. Thanks for having me, John. Interesting story as always. Paul Goddard joining us from Pizza Pizza.
Still plenty of maneuvering to go between Teck and Glencore. Teck, of course, just warned investors that its coal sales lately have been softer than expected, or at least at the lowest end of its projection. Glencore has been spurned or was spurned with its $20 billion plus takeover approach for Teck, but did raise the possibility of just buying out the coal business at Teck. So lots of maneuvering ahead. We're joined now by John Mills, an equity analyst at Morningstar in Australia, where it's pretty early. John, thanks very much for coming on the show.
Good evening. How are you doing?
That's right. It's just before 6 p.m. there. I think it's about 7 breakfast time there.
It is. It is.
Really appreciate you giving us the time. Where do you think this goes? If you had to place a bet, do you think Glencore will get to swallow the whole of Teck?
I think that's probably a likely scenario. I mean, it's a typical M&A back and forth. Teck is playing hard to get. Glencore obviously doesn't want to use its biggest offer at this stage, but I think Glencore is very interested in Teck. It has been for a few years, and I think ultimately they'll come to some sort of arrangement.
We've heard that, the copper is the crown jewel of Teck, but there's a school of thought that Gary Nagle, the Glencore boss, really wants to get the coal to package with his own coal assets to create a palatable spin-off. Do you think, is the coal really the thing Glencore is after?
Well, I think it's both. I mean, Teck has got two attractions to an acquirer. I mean, first of all, it has a decent copper business, but it also has a big copper growth pipeline. So if you're a miner that wants to increase copper exposure, Teck is one of the best opportunities to do so. But you're right that coal is also an attraction to at least Glencore, because steelmaking coal and even thermal coal are not going to go away for decades, in my view. And Teck has some of the best steelmaking coal operations on Earth, and we think their coal is going to be in demand for decades for use along with iron ore to create steel in the blast furnace process.
I glossed over your first answer there, John. I'm sorry. You think there is a pretty strong prospect that they will strike a deal? I know there's other companies are in the mix.
Yeah, look, I mean, someone might come up with a better offer, but in reality, while Glencore has its steelmaking coal business, majors like BHP or Rio they're unlikely to bid because they don't want to deal with the ESG headaches. I mean, obviously the BHP and Rio in particular are iron ore and copper. They don't want to deal with coal or any more coal in the case of BHP. So look, something needs to happen with the steelmaking coal business in all likelihood, and Glencore knows this, and that's why they've suggested that, if Teck doesn't want to be taken over completely, then maybe they can part with their steelmaking coal business.
No mining company has completely clean hands, but of course Teck made hay, as people do in a hostile situation with the corruption settlement that Glencore had to push through. It is a controversial company. Do you think that handicaps it here?
Yeah, look, I mean, you're correct, and it has its history doesn't help it in these types of situations, and Teck's taking full advantage of that as they have every right to do. I think, look, that's probably in the past. I mean, Glencore traditionally has operated in countries where, how can I put it? You have to do certain things to get licenses, and obviously we in the West don't like that. Mm-hmm. But I think under the new CEO Gary Nagle, that's in the past, and so look, they're gonna keep coming back and trying to negotiate with Teck, and it's up to Teck or even a third party to try and stop them.
And that's interesting. You said BHP and Rio Tinto, obviously with deep Australian connections. You think that they might steer clear? They just don't want to get embroiled with coal, even if they could do a spin-off?
Yeah, exactly. It's just too much headache for not much gain. I mean, as I said earlier, I mean, BHP and Rio, it's essentially iron ore and then copper. Rio obviously has its aluminium assets, some really good assets in Canada, actually. Rio's already out of all coal. BHP it's still got thermal and met. I mean, it's a small part of their business. And so, look, it's just too big a headache to try and take over Teck while it still has its steelmaking coal operations.
And actually, just remind us, if you would, Australia itself is still a pretty big coal exporter. Who are the players in the Australian coal industry?
Yeah, look, I mean, you have BHP with its Queensland steelmaking coal and New South Wales thermal coal operations. Okay. But you have independent companies like Whitehaven Coal and New Hope Coal, which are thermal coal exporters, and they export most of their production rather than selling into Australia. So There's other smaller companies, but none of the majors are big in coal anymore.
John, we'd better jump. I really appreciate it. Are you in Sydney, as a matter of fact?
Yeah, I am. Yeah, it's supposed to be quite warm today, which is a nice change.
Yeah.
We're in the middle of winter.
It's winter there. I was in your city a few years ago and really had a good time. And like Melbourne as well, but I'll say they're equal. I know you're great rivals. Thanks very much indeed, John.
Okay, time now for Hot Picks. Today we are talking currencies, especially at a time where we've seen the Canadian dollar rally to 2023 highs on the back of the Bank of Canada's rate decision, but also some pretty big weakness in the U.S. dollar broadly recently. Let's bring in Sean Osborne, Managing Director and Chief FX Strategist at Scotiabank. Thanks so much for being with me. So the Canadian dollar has been this little engine that could, even though we haven't seen much move in oil prices now. Right. It's a rate story?
Yeah, it's principally a rate story, I think. And our view has been that the second half of the year probably would be a little bit less kind to the US dollar generally. Our view has been...
How much unkinder could it be? Because it's been...
I should have been here last week, basically, to talk about this, because we've had a big move in the dollar this week. We're generally a 2.5% fall in the dollar against the major currencies. So US inflation coming in a bit weaker than expected. Markets are convinced increasingly that the Fed is very close to the peak in the rate cycle. I think that's probably correct. We might be just 2 weeks away from the last rate hike in this cycle. I think policymakers are going to want to keep the door open to high rates in the US, so it's going to be a bit of a bumpy ride, but the dollar is, I think, going to weaken a bit more substantially in the second half of the year.
So what does that mean for how high the Canadian dollar could go against the US dollar?
So, I mean, from our point of view, we're looking for something very close to current levels. We're not changing our year-end forecast at the moment, so something around 77.
We rallied from like 72 to where we are now, 75.
So something around 72 cents probably makes sense. I think there's high degrees...
Not 72.
No, 77 cents.
77, yes.
77 cents is our forecast.
Yes.
But I do think there's a bit of an overshoot risk in the next 2 or 3 months. There's a lot of seasonality in currencies, so the US dollar tends to trade relatively softly in Q2 and Q3, tends to rally a little bit in the final quarter of the year. So there's maybe a bit of an overshoot risk, maybe 78.5 cents, possibly a little bit more for the Canadian dollar.
Does that start to become a problem for the economy?
I don't necessarily think so. I mean, I think one thing the Bank of Canada didn't want to do this week was firmly close the door on more interest rate increases, because I think that would have triggered a lot more Canadian dollar softness than we've seen. The Canadian dollar is actually lagging quite badly behind. Everything else has moved 2.5%, 3%. Norwegian kroner's up 6% this week. Australian dollar's up 2.5%. The Canadian dollar's up 1%. So it has lagged. But I think it would have weakened if the bank had shut the door on more interest rate increases. It's highly unlikely, I think, that we do get more interest rate hikes in Canada at this point. But if they'd firmly closed the door on more rate increases, we probably would have seen the Canadian dollar weaken. That would have complicated the inflation fight, I think, for the bank.
Now, with the U.S. dollar weakness, because you're still calling for weakness there, if they change, if they're hawkish, if there are more rate hikes than what the market is thinking, is there a material risk of an upside re-rating?
Oh, certainly. I think, we're pricing in, or the markets are starting to price in the first rate decreases in the US early next year. That's probably a little bit too soon from our point of view. But we can see from history that markets are very quick to discount the end of one tightening cycle and the start of an easing phase in the US. Since the 1970s, the last rate hike in the cycle has pretty much coincided precisely with the top of the dollar. The dollar has tended to weaken very quickly after the last rate hike. Now, that's usually, or probably, because previously we've seen some sort of economic event or some sort of communication that has persuaded markets that this is the last in the cycle. We haven't got that this time around, so it may be a little bit of a bumpy ride for the US dollar, and it's quite possible, in fact, that inflation numbers might creep up a little bit again in the next few months. Favorable base effects are probably going to start to move out the year-over-year calculation, so it's going to take some very weak month-over-month numbers to get that inflation number running lower. But I think generally we've kind of broken the back of inflation at this point, and the Fed probably feels that it's done enough. At this stage, we've seen some softening in the labor markets as well. And the rate story has been the primary pillar of the US dollar strength that we've seen over the last couple of years. So kind of US exceptionalism story of higher growth, higher interest rates has really provided the US dollar with a lot of support. So as we transition into the next phase, which we think is going to be driven largely by US interest rate, North American actually, interest rate declines. First in, first out kind of argument here in that the Fed and the bank were two of the first major central banks to start raising interest rates. It makes sense that they're probably going to be two of the first to start easing interest rates when we get there. Interest rates probably higher for longer in Europe. It spells a bit more pressure on the dollar from a medium to longer run point of view.
The pound is also a rate story as well.
Right, very
and
much
your
so.
call is for the pound to continue rallying. Is that because you don't see them stepping off the gas as much as...
So a couple of points there. I think valuation is one consideration. For the pound, it's recovered quite strongly from the huge losses that we saw late last year. There was that period in September, October when sterling and UK markets generally got crushed by this
what would you call
fiscal policy calamity, shall we say?
Misstep,
Yeah. So
hiccup.
We've been kind. So we got down to close to par against the US dollar at that point. We're back to around 130, a little above that point right now. And I think there's the potential there for a bit more sterling strength. It probably is likely to be one of the better performers over the next 2 or 3 months.
I mean, it's almost back to its pre-Brexit level versus the US dollar.
Right. So the the post-Brexit range for sterling against the US dollar was very consistently 120 to 140. So we're right back to the middle of that range, essentially, at this point. UK interest rates are at a premium to US interest rates quite substantially at this point, half a percentage point. And it looks like the Bank of England, at the August meeting, very likely to raise rates another 50 basis points. Markets are discounting quite significantly more interest rate increases down the road. We're not persuaded that the market pricing is correct, but the story is higher interest rates and an interest rate premium for the pound. So relatively cheap valuation still, plus significantly higher interest rates relative to the US. The pound has a good chance here of maybe getting back to, at least temporarily, the top of that post-Brexit trading range around about that 140 point.
And now I just want to clarify, is this is your call for the pound against the yen, or are you also bullish on the yen?
So I think the yen is another consideration for us. The yen's still relatively cheap. So late last year, the Bank of Japan...
But they have a different central bank world altogether.
And the one consideration here is that interest rates in Japan are still very low, in fact negative at the short end of the curve. So the yen is an expensive currency trade to put on. It's an expensive carry. The yen, I think from a trading point of view, makes sense against another low-yielding currency, something like the Swiss franc.
Okay.
But the story for the yen, I think, is essentially that, again, it's still relatively cheap. Officials have started to make noises again recently anyway, about yen weakness. There is a chance at the Bank of Japan's policy meeting at the end of this month that they do make a tweak that everyone's kind of been talking about for some time to its yield curve control policy. Which may allow long-term interest rates in Japan to creep up just very marginally. But it will be the first step, perhaps, in a very slow process towards some sort of normalization, whatever that means for Japan in the long run, in interest rate policy.
All right. Thank you very much, Sean Osborne, joining us from Scotia for today's Hot Picks.